Welcome. If you do not know me, I'm Brianna Beers, Bree to my friends, and I own the newly rebranded Bree Beers and Associates, formerly Lipa Beers and Associates. So we are a small business, and we're a tax firm, and we specialize in helping small businesses and their owners and other individuals with tax prep and tax planning. Tax planning is our jam because it's where we get to strategize with our clients to minimize their annual tax burden and find ways to keep that extra cash in their pockets to invest back into themselves and into their business. You might be watching this in a variety of places, but if it's not in our awesome Facebook community, Money, Taxes, and Finance for Small Business, you are missing out. If you are a business owner, you should definitely hop on over there and join that group. It is an amazing and supportive community. Where we have weekly trainings on Monday mornings at 10 a.m. We also have weekly updates and Q&As on Friday afternoons and daily tips, tricks, and conversations about how to improve your finances in your business. So today we are talking about estimated tax payments. I've been getting so many questions about what are my estimates? How do I calculate them? When are they due? And this year, it's all weird. Right? I mean, it's been crazy just in life in general, right? But from a tax point of view, it is also insane. For those of you that don't know, so tax day is usually April 15th, right? For individuals and corporations. And then you might file an extension that gives you till October. But even if you file an extension for your 19 tax return, you still have estimated tax payments to make, and we'll talk about that. But this year, tax day was moved to July 15th, as well as Q1 2020 estimated payments and Q2 estimated 2020 payments. So today we're going to talk about what's normal. We're going to talk about how 2020 is a little different. I'll intermingle. I'll give you guys some details on how 2020 is different than normal. But most of what we're talking about today applies whether it's this year, next year, years to come, unless they change some tax law. So let's start with what are quarterly estimates, right? What are quarterly estimated tax payments? So the IRS says that taxes have to be paid as you earn or receive income during the year. Okay, so either through withholding or through estimated tax payments. And when you're a W-2 employee, right, your taxes are paid through payroll deductions, right? So if you make $1,000 gross, income on your paycheck, they take out your taxes, and we'll talk about all the different pieces of taxes that they take out as well. But when you're a W-2 employee, they take out your employee portion of your payroll taxes. Okay, so you hear the words FICA, Social Security, Medicare, right? But then they also withhold your federal and state income tax through your payroll deductions. All right, so that's why if you look at your W-2 pay stub, you might have had gross earnings of $1,000, but you only brought home $700, right? You're like, where did the rest of that money go? Well, some of it went to your payroll taxes, and some of it went to your federal income tax withholding, and some of it went to your state income tax withholding. Then if your W-2 holding isn't enough at the end of the year, or if you receive maybe income from other avenues where taxes aren't withheld, you're likely going to owe money, right? When you file your tax return. And the way you avoid owing that big chunk of money when you file taxes is by making estimated tax payments. All right, so when we talk about receiving income from other avenues, we're talking about, it could be investment income, right? Your interest income, your dividends, your capital gains. It could be also investment income maybe from partnerships. It could be alimony. If your alimony income is taxable, you might, you're not having income on that. You might have retirement distributions, from your retirement account or maybe from your Social Security. And if you're not having income tax withheld, you're essentially building up a tax bill. All right. And the other one, and the big one, especially when it comes to this group, is your self-employment income. All right. So going back to the W-2, right? When you work for someone else and you receive a W-2, they withhold that tax, right? But when you are self-employed in any aspect, all right? Okay. If you're a sole proprietor, If you're just an independent contractor and you earn all of your money through 1099s, if you're a single member LLC, if you're a multi-member or a partnership LLC, if you're, so any of these different types of any ways of earning income, all right, if you have earned income and you're not paying taxes on it, all right, through it, then you should be paying estimated tax payments, okay? Otherwise, again, tax time comes, you owe this big, huge bill. And then, so that's what we're gonna talk about now. Why should you be making estimated tax payments? If you're in business for yourself, like we said, you wanna be making these estimated tax payments or these quarterly tax payments because, again, none of your business income is being subject to any sort of withholding. All right, so you're earning money, but you're not paying the taxes due on that earned money, okay? And then a piece that you've got to remember is that estimated taxes, we use those quarterly estimates to not only pay that income tax, all right? So we talk about what income tax bracket you're in, right? We always talk about that. What tax bracket are you in? Oh, I'm in the 12% tax bracket. I'm in the 24% tax bracket, okay? That's your income tax, right? Your income tax bracket. But when you're self-employed, you also have to pay self-employment tax, all right? And then if you're a super high earner, whether you're self-employed or not, you may have AMT, alternative minimum tax. We're not talking about that nonsense today. We are just going to be focused on your income tax and your self-employment tax. So part of why we want to pay these estimated taxes, because like we said, the government, the IRS wants their money when it's earned, okay? And instead of saying, okay, sole proprietor, you have to pay in your taxes every week, they make it a little easier and they say, okay, you can make quarterly estimated tax payments. Each quarter, we want you to pay in the chunk of money you owe for the income tax on the earned income you have, all right? And if you don't, there's going to be penalties, all right? And there are so many different little types of penalties that you can get assessed. Today, we're going to talk about the underpayment penalty. So what that says is that, each quarter, they look at how much income you earned, and then they calculate, they meaning the IRS, they would calculate how much income tax would be due on each of those quarters. And if you didn't pay that much in, they're going to say you underpaid. And so you're going to get these underpayment penalties. There's also late penalties as well that say when it's due. So the underpayment penalty, let me start there. So underpayment penalties can be avoided. Okay, and that's where we're starting today. How do I avoid payments or penalties and interest? Okay. So underpayment penalties can be avoided if you owe less than $1,000 in tax at the end of the year, if you paid in at least 90% of your tax for the current year, or they talk about paid in 100% of last year's tax liability, 110% if you're a high income earner. And so there's that caveat there, you guys. So first says if you don't owe $1,000, we're not going to charge you underpayment penalties. Okay, that we're gonna say you were close enough in your estimates. Okay, either because you didn't owe a lot of tax or you did make estimated payments throughout the year. If you owe less than $1,000 when you file your tax return, there are no underpayment penalties due. Okay, again, underpayment penalties are just one of the types of penalties that can be assessed, but we've avoided those. And then they're going to say, if you do owe more than $1,000, they're going to say, okay, there's a test we can do. Did you pay in at least 90% of this year's tax? Okay, and if you did, they're not going to charge those underpayment penalties. So even if you owe, $6,000 when you file your tax return, because this year you made a lot more, right? So therefore you owed a lot more in tax. They're going to say you still paid 90% of what was due, so we're good. Or finally, they're going to say as long as you paid 100% of last year's. And that's really put in place, you guys, for those of us that fluctuate up and down, okay? So what that protects you from, so last year, let's say you had $10,000 in tax liability for the year, okay? And as long as you paid in $10,000 this year, they're going to call it good. Again, even if you owe tens of thousands of dollars more, okay? As long as you pass one of those two tests, either that you've paid in 90% of this year's, so I gave you the wrong example, 90% of this year's or 100% of last year's. So I'm going to go over that one more time because I totally explained that backwards. So I explained the 100% of last year's correctly, okay? So even if you made a ton more money this year, let's say you doubled your revenue, therefore you doubled your tax, as long as you paid in at least what you owed last year, they're not going to charge you underpayment penalties. The 90% of this year's comes in, let's say you made less this year. right? So let's say last year you knew it was a killer year. You had, you made $1 million and that was just a, fluke. And this year you're back to normal. Let's say that's, let's say normally you make $20,000 or something. Okay. As long as you paid in 90% of what you owe for this year. Okay. So anyway, don't struggle over that. The point is the underpayment penalties, there's a few ways to just kind of get at it, to avoid those. Okay. And at its simplest form, that is what you want to do. Okay. You want to avoid any unnecessary penalties when all is said and done, right? Because who wants to pay the government unnecessarily, right? Because then if there's penalties, there's also likely interest and just a hot mess of things. Okay. So let's talk now about who has to make estimated tax payments. All right, individuals, like we said, so sole proprietors, partners in a partnership, S Corp shareholders who expect to owe, again, more than $1,000 when they file their return should make estimated payments. For my S Corp shareholders, right, you're also a W-2 employee, so you might pay enough in through your W-2. So we're not really talking to you today. So we're talking to my sole props, my partners, my LLC owners, all of you guys, okay? And then also, I'm not sure there's many of you in here, but my C Corps, okay? If you expect to owe more than $500 when you file your return, you should be making estimated payments for your corporation. All right, so here's the fun part. When do you make the estimated payments? It's not fun, it's just fun. This year's different, okay? So normally, let's talk about estimated tax payments. So you have quarterly taxes, right? So first quarter, okay, covers January, February, and March, and it's due April 15th. Second quarter, it's going to cover April and May. I know that's so wrong, right? And it's due June 15th normally, which would be today. Third quarter is going to cover June, July, and August, and it's due September 15th. And fourth quarter is going to cover September, October, November, December, and it's due January 15th of the following year. Yeah, so annoying that they're not on quarters, exactly. It drives me insane, but that's how the IRS works. I don't know. So this year, you guys, for 2020, your first and second quarter tax payments aren't due until July 15th because your tax return for last year isn't due till July 15th. Nothing. They pushed everything back. Report dates, payment dates, everything is July 15th this year. Next, how do you make estimated tax payments? So we're always going to suggest you make it online. It's easier. There's the trail is great, but you can also make them by phone or by mail. We right now in pandemic are not recommending you do anything by mail because the IRS's mail rooms are crazy overflowing and not sure when they would ever get to your mail. Honestly. So Karen says, so my estimated paper from my accountant said Q2 was due today, so I paid it. That's okay, right? Maybe I should have reached out to them before I paid it, but I didn't. So that's on me. No, there's no harm, Karen. And actually, I think your accountant probably filed your return like on time. So before all this craziness happened and everything got pushed back, because second quarter, you guys, let's see, let me, I'm trying to think back. So March 15th is when they moved tax day. So that's when they also moved first quarter payments that were normally due back in April. Second quarter payments weren't moved, I want to say, until sometime at the end of April, maybe even the beginning of May is when they decided second quarter payments also shouldn't be due, which makes sense. They should have made that call from the get-go. So anyone that filed their return before then, whether you use TurboTax, anything online, or you have an accountant, the paperwork you received may not have addressed that. So, but no harm in doing it early. The point of moving it is just to give people that extra time with all the chaos that's going on. So now, guys, I want to touch briefly on how you calculate your estimated tax payments, okay? Because this is something I get asked a lot. So I'm going to give you three methods that you can use. So the first one's going to be the easiest way to calculate your estimated tax payments, but it's also going to have the least amount of accuracy, right? And the more effort or the more accurate we're able to, the more time we take to calculate those estimates, the more accurate those numbers are going to be. Okay, this will make sense when we get into it. Okay, so first, like I said, you can base them off last year's return. If you base them off last year's return, they give that rule that says you just need to pay in 100% of last year's, 110% if you're a high earner. I can't remember the exact break off for a high earner for 19. I know you're going to ask that, but it says, okay, so we're going to use last year's income to create this year's estimated payments. All right. And by doing this, you're going to alleviate those underpayment penalties. You're going to alleviate the late payment penalties as well. You're going to minimize your balance due come tax time, right? So even if you, like I said, even if you make a ton more money this year in 2020 than you did last year, your balance due is going to be less because you made those payments throughout the year. Using this method, you guys can and most likely will lead to an overpayment if current year's income is lower than last year's, right? So if last year I made $100,000 and I paid income, and this year I'm paying my estimates based on $100,000, and then when we do our tax returns, we find out we only made $70,000, then we are going to have an overpayment that we need to figure out, what to do with. Or, like I said, you might still end up owing money at year end if you end up making more money this year. And then most tax preparers, you guys, and I think even some tax softwares, I will double check on that, but for sure, your tax preparer should be providing at minimum these estimated tax amounts or payment amounts when they prepare your tax return. Okay, so what I'm saying there is, like for us, when we do your 19 return, right, we'll say, okay, at the very least, your tax preparer, when you get your tax return, your 2019 tax return, okay, whether you owe money, you're receiving money back, whatever, in that cover letter you get, it should tell you that if estimated tax payments for this year are suggested. And when they're suggesting those payments, it's based off last year. Okay, so how I want you to read that is, okay, if I make the same amount of money this year, that's how much I'm going to owe. And a lot of tax preparers can actually even set you up on automatic tax payments for estimated tax payments if you do anticipate the same amount, or if that's just what you want to do. We have a lot of clients who don't want to sit down with us throughout the year and calculate the actual amounts for the current year. So they just have the mentality, they're like, I'm going to pay in what I paid in last year, and whatever happens this year, I might get money back. I might have made a lot more and I might owe a lot more, and that's fine. But that's what I want to do. So most tax preparers will provide these estimated tax amounts. And then don't forget, you guys, when you're making estimated tax payments, that if you live in a state that has income tax, that you also pay your state estimated tax payments. In Colorado, our tax rate is 4.65%. Okay, so we tell our clients to pay in 4.5%. So that's the quickest way. That's the easiest, quickest, but least accurate way to make your estimated tax payments. The next way is to base it off this year's income, right? So this is super easy, you guys, if you keep your books, your finances up to date. All right, whether it's an Excel, QuickBooks, something else, if you keep your books, your business books, pretty current, then calculating a more accurate estimated tax payment amount isn't going to be hard, okay? But it's going to be more accurate than basing it off last year's. All right, and we definitely recommend this, you guys, if your income or your expenses either fluctuates year to year, or at least in the current year, you anticipate it's going to fluctuate, right? So in real time, we're living, COVID-19 life, and for all of us, to some capacity, it affected our income, right? And so a lot of our clients are like, I know I'm going to make a lot less than last year, so I don't want to pay in what I paid in last year because I'm going to overpay. So I want to pay in a more accurate amount. So they want to look at their books at those, at these periods, at these month-end periods, and make estimated tax payments based on that amount, okay? Based on that income. And if you're going to do this, how you're going to do it is you're going to take your gross receipts less your expenses. So if let's pretend we're living in a regular world and it's April 15th and we're trying to make our first quarter payment. So we pull up our finances from January 1st to March 31st. We see that we had $10,000 in gross income and we spent $5,000 on various expenses. So our net profit, our net income is $5,000. So that is the amount we're going to base our income tax payments off of, our quarterly estimated tax payment off of, okay? For this year, you guys, when July 15th rolls around, you can make your, and here's where I'm not sure, I have to look into. I'm not sure if you still have to turn in a Q1 and a Q2, estimated payment voucher, or if you can just turn in one and I don't know how they're going to do it. Or if you do it online, you say, what period is this for? And so I'm going to tell you to err on making it all first quarter. If you're going to make your first, so what I'm telling you guys this year for 2020, if you are making your first and second quarter payments together, okay, as one, label them all as first quarter, not second quarter, or split them into first and second quarter, one or the other. And the reason I say that is because I doubt that IRS's system is going to, they're not going to change it. They're going to still say first quarter is assigned to first quarter, second quarter is assigned to second quarter. And if you assign all of your tax payment to second quarter, they're going to the system's going to kick back that your first quarter is late. Okay, even though they're receiving it all the same day. So I just don't know how the IRS is going to set their system up. So there's no harm in doing it the way I told you to. All right. For ease, you guys, we recommend that you make a 30%, you pay in 30% to your federal if your year-to-date income, net income for your business is less than $40,000. 40% if your business nets more than that. You're going to say, whoa, there are no 30 and 40% tax brackets, or I don't make that much. Why am I paying in so much? And it goes back to what we talked about with the self-employment income. So we touched on it for a second. I want to circle back around to it. Okay, so self-employment tax that you owe when you're not a W-2 employee replaces that FICA, the Social Security, the Medicare, right? The government still wants a payroll tax. So instead of paying payroll tax like you would as a W-2 employee, and then your employer paying their half of payroll tax as they would, as a W-2 employer, you as a self-employed person have to pay it all. Okay, and that's 15.3% of your net business income. Okay, so if we add that 15.3% plus your income tax bracket, income tax amount, right? You're going to end up paying a higher percentage. So we say 30% if you make less than 40,000, or 40% if your business nets more than that. Okay, again, this is a blanket statement. It's not going to be exact, okay, but it should, for most of our clients, it ends up being on the conservative side of estimating it, meaning you end up with a slight or large overpayment. And then if you want to even take it to a more precise, level and be even more accurate, I want you to go back and watch my very first episode or video in this group, in Money, Tax, and Finance for Small Business Facebook group, because we talked how to break it down. Okay, and there was a spreadsheet. There's a spreadsheet to help you break it down even farther. It does get a little more complex. It's still not hard, but it is a little bit more complex. And this is going to be highly suggested for those of you that maybe have income from multiple places, have other income tax being withheld somewhere that you want to account for, things like that. But for those of you that just have a small business, that's your only source of income, basing it off your financials and just using that 30 or 40% should be okay. Okay, for the time it takes to do it. If you want to, and if you want that even more precise, you want to be even more precise, I suggest working with a tax advisor. And that's actually something we do at Bree Beers and Associates. Like I said, in my intro, we love tax planning, and this is like basic. This is like tax planning 101, right? Is I just want to pay in enough tax by the end of the year that I don't owe money when I file my tax return. And we do that. Some of our clients, that's all they want. They don't need tax savings. They don't want to worry about, getting creative there yet, but they just want to make sure they're not paying penalties and interest. They don't care how much tax they owe as long as it's just tax, not penalties, not interest. So that is like we do that, we do tax planning for them. So so to give you guys just a little bit of background on us before I let you go, when we prepare Bree Beers and Associates, when we prepare your 19 tax return, okay, we provide you, like I said, with those estimated I talked about this, with those estimated tax amounts based on last year's. And then when tax season's over, we actually send basic tax projections or tax planners to all of our clients. And this basic tax planner says, okay, if your tax info, meaning your earnings, your deductions, your adjustments for this year are similar to last year's, this is what your taxes look like. This is what you're going to owe. This is what your estimate payment should be based on 2020 laws. And that works great for a lot of our clients. That's all they need to know to make sure that they are just avoiding those penalties and interest and paying in what they need to. And that works well for our clients whose income doesn't fluctuate a lot, okay? Or they don't have a lot of moving pieces. But for those of you that maybe in some way or another are a little more complex than that for whatever reason, we offer tax planning packages, that a spectrum of them, you guys, from the basics I'm just talking about all the way, I mean, we have some high-end stuff because we do have some bigger businesses and individuals with multiple businesses and such that need a lot more in-depth. Our mid-range is where most of our clients who engage us in tax planning fall. And what they want to do is not only do they want to avoid these penalties and interest, but they also want to minimize their tax. They want to know, how can I reinvest in my business? How can I invest in retirement? How can I invest my money into college savings for my kids, etc.? And if I do those things, how much money does that save me? So that's kind of where we are. So that's that. I see comments. It's my best friend, Karen. She's not really my best friend, you guys, but she makes me smile. So hi, Karen. Okay, got it. Not on this topic, but I am assuming the IRS is backlogged on processing returns too. Is that correct? I only asked because I haven't heard anything about my return that was submitted. To be honest, I forgot about it until now. That's normal. Karen, I got you. Yeah, you guys, there's been a lot of backlog on the IRS processing, but not consistently backlogged. We are still having clients whose returns are being processed in a couple days, and we have other clients. I'm not sure what our longest client has been at this point, but I know, I'm a part of like different CPA and accounting, groups. And I'm trying to think of the exact timeline. There was a client who had been waiting almost 2 months just to have their return actually accepted. Okay, that had nothing to do with receiving money or receiving a refund, just to have it accepted. So it has been kind of bizarre in that fact that it's not, oh yeah, everybody's experiencing a delay, because it's not everyone. So it's been really weird in that front, that some are still getting processed relatively quickly while others, like I said, are taking forever. If for some reason you guys are on here, if you paper file, I honestly I have no idea when they're going to be able to process your return, because like I said, their mail rooms are crazy backlogged, because they were close, you guys, they were on like minimal staffing, like essential only staffing. I haven't checked in the last week or two to see where they are now. The IRS is, if you got to think about, and not to make excuses, but if you think about the IRS, they're always, pandemic aside, okay, the IRS is running with outdated software. They seem to always be running underfunded and understaffed. And you throw in this pandemic, right? Which means they're understaffed even more. You throw in the CARES Act and all the pandemic guidance they've received that they're supposed to now implement and write, guidance for and work with the Treasury to do. And it's just, what a hot mess. All right. What a hot mess. So if you end up paper filing, or if you send any sort of paper correspondence to the IRS, abatement letters, inquiries, anything of the sort, be patient. That's actually on my list of things to do in the next week or two, is just see where they were, because actually part of the CARES Act, or maybe right before the CARES Act passed, they passed a whole piece of legislation on all the way, everything that the IRS was postponing. So in the piece of legislation that said tax returns, 2019 tax returns, Q1 and Q2 2020 payments are all due July 15th. They also explained a bunch of other stuff that they were postponing, or putting on hold or putting on hiatus. So lots of craziness. I don't know, just side note, everyone I know is we're all in different places wherever we are. Some states are kind of going back to normal, some aren't, but it's just it's interesting to feel the difference. Well, you feel some states and some cities are going totally back to normal, to see some that are completely still shut down and kaputzed. So All right, I've gone over. My 1030 is probably wondering where I am. So that said, if you guys are watching this on replay and you have any questions, make sure you tag me. Otherwise, I will not see your questions. Otherwise, I will see you guys Friday for updates and Q&A. Have a good one, guys.